All right, I always like to start off the show with a kind of a summary of what I saw happening with the markets this week. Let's start off with the signals actually, because we have new signals all the way across. Some are new, but they're all green now. So the stocks, again, the fast signal just means that we are looking at things that are in IRAs and those types of areas where we don't have to worry about tax consequences for buying and selling. The slow signals more for our taxable accounts. Both are green right now. And then our bond signals are also both green. They've been kind of struggling for a while,
Yep.
bond market, so it's nice to see it sort of rallying up here. It's had a really nice rally recently. So, uh, and this is kind of what's happening right now, and I'll point out some of the main pieces here. So if we look at the chart, you can see here over the last couple of weeks, we've had a tremendous run up. I mean,
Yeah,
just one
I
of the
should go
best.
on vacation more often.
Yeah, that's right. Yeah, what's the last week was 5.9%,
Yeah.
right? And really was kind of incredible. This week we're up 4 out of the 5 days. Where are we at right now? Are we above 4,400?
Oh my
So
gosh.
this is a fairly important component of what's happening today is just making sure that we're establishing a new high and that we stay above 4,400 at the close.
Yeah, so right now we're at 4408 for S&P.
Okay, we're just barely above it, but that's a big deal, actually. Lots of articles out there talking about 4,400. Closing above 4,400 would basically say that this downturn is over. I don't know if I agree with that completely, but if enough people believe in it, maybe we'll see some, motion in the market as far as that goes. But um, you can see this particular chart. You've got the big run up in 2021, peaking out, the very beginning of 2022, giant downturns, and upturns happening all the way through 2022. You see those big peaks, but every one of those peaks was lower,
Hmm.
and we finally hit a low on October 13th of last year, and we had a pretty decent run. Still a lot of volatility, but we ran all the way up until the 31st of July, which is kind of nice. And now we've had, the biggest downturn since last October. That's just happened. We hit this low just before Halloween, and we have been really flying ever since. And so let's just talk about kind of why we're flying. And it has a lot to do with what we've been talking about for quite a while now. And that's really this support zone. Yeah, 4,200 to 4,050 on the S&P 500. If you look inside those two lines, you see that the market spent a lot of time there,
Hmm.
and it went sideways there, and it went up and down there. And what that means is that there were a lot of shares accumulated at that price. And so when the market ran, and it kind of ran too hard. If you look at it, it ran up out of that zone just straight up. It had to kind of backfill that,
Hmm.
right? Because there just wasn't enough support there. Didn't spend enough time at those prices. But the hope was, and so far it's been true, was once it got into that zone, we might find some support. We might see some, buying happening, and a little bit of buying happening all of a sudden causes a bunch of, people that are shorting the market to buy the stocks back, right? And so that's, you get this run going, and that's exactly kind of what I saw last week.
Yeah, 5% a week is essentially could be a year's worth of return, or half a year's of returns in a week.
Yeah, and it is one of the problems with investing. It's one of the problems with kind of moving in and out or doing any of those things is that you miss one day like or one week like that because you were out for some reason. It's really easy to miss most of the returns for the year. Seen lots of stats that show the best 5 days of the year if you're out, you miss almost all of the return for the year. I'm making that up, but in general, that's the idea behind that. And so luckily for us, our system has us in really, I think, since February, just because, the market is in an upward trend. Yeah. And once it's in that primary upward trend, and again, the things we look for is lows that are higher over and over again. So you can see we had, four of them now, including this last one. All of them are higher. And that's why I was not so worried about this particular downturn because we've just kind of gotten ahead of ourselves. It had quite a ways to go to establish a new low that was lower, which then would have triggered some alarms for me, but we weren't there yet. We were just getting into that zone. And so, even though we were down 10% from that high, part of the reason we're down 10% is because we were up, 10, 15% just
Hmm.
before that and kind of a crazy run, really kind of fueled by the debt ceiling being resolved and then the NVIDIA's, unbelievable earning results revolving around the potential for artificial intelligence, right? It kind of created that big jump. And so we settled back in. That's great. I think that's healthy. This is what's supposed to happen. having that continue to go straight up past July, everybody might be excited for a while, but that's what happened in 2000.
Oh, yeah. Yep.
And things went so nuts. I remember, I think it was 1998, the Nasdaq doubled. It sounds great, sounds like fun. Except for the problem is once it gets so stretched out, it starts to come back down almost as fast, and then it creates a panic. And all of a sudden, you're down 45% from the high, and you've got this huge downturn that we're still talking about. So, you don't want that. You want these little runs, and then you kind of consolidate, pull back, little runs, pull back. And so what we're doing right now is actually quite healthy, in my opinion. It's working. Inflation is still on the decrease, which we really want to see. And so, those are angles that I think are important. And then, of course, if you look, one of the things that was happening here that was somewhat concerning is we were starting to establish another trend where the highs were lower.
Yeah, which is kind of scary.
Yeah. Yeah, it's exactly what happened in 2022. All four of those big highs were lower. We were doing it again, but that's what's so significant about this week. We actually broke through, right? And we established, it's a little hard to see that here. The third high was at 43.76, right? And so we closed above that twice, Tuesday, Wednesday. And then Thursday, we were down, 0.8% yesterday. And I talked about this on the Wednesday video. I talked about how, the Federal Reserve was going to be out in force and doing all these interviews and different things, question and answer sessions. And Chairman Powell was going to be speaking on Thursday. And in November 1st, they came out, they didn't raise rates. And they said, we don't need to raise rates, especially since the market is already kind of raising rates for us because the 10-year Treasury was all the way up to 5%. And so all of a sudden, the 10-year Treasury ended up at 4.5% yield. And so that makes easier monetary scenario, which is not what you want if you're the Federal Reserve and you're trying to, tighten monetary supply so that inflation can continue to drop down to their 2% target. And so I was worried that they were going to come out much more aggressively, and that's exactly what happened on Thursday.
Yeah. If you looked at the CME FedWatch tool, it went from 95 to 85%.
Yep.
Today it's back up to 90% of holding rates. So you can see how the market shifts so much on those comments.
Yeah, they call it job owning, right? So they're going to try to job own the markets into reacting so that they don't have to raise rates as much. And they've been doing that, and this is not completely normal. November of 2021 is when they really started doing this. And it creates all kinds of volatility. It works to a certain degree, although look at how much we're up really since the October low of last year. So it's not really working. They've been trying. The markets are the markets. They're going to overcome job owning in the end. And this last one was one day. We gave away 0.8%. We were up 1.3% before the show started here on the S&P anyway. And, because the reality is that the market is really, in a spot now where we're starting to confirm the next leg of this upturn. If this downturn leg that we're on now is going to be officially over, which really would happen when we get above it, but nonetheless, there's like a checkbox, right, of different things we look at. We checked off, hey, we made it past 43.76, check. We set a new high that was higher than the previous highs. Next one is, hey, we got above 4,400, big psychological thing being. The next one would really be set another high past that second high, and then of course the last one would be get back to that high of July. We're a ways away from that. November is the second best month of the year historically. This is the beginning of the best 6 months of the year historically also. So there's some good things that are happening. And part of the reason we might have sold off so much at the end of October is that mutual funds are allowed to capture their losses up until the 31st of October for the year. So any losses they gather after that would happen for next year. And so you see a lot of selling to capture those losses. And then, you got to buy something with that. And so you get that big V scenario that we have here.
Yeah.
Could be partly, revolving around that mutual fund, deadline that's happening. And so November can be a good month. That helps. Now, there's another thing that happened here that's really interesting. There's a gentleman named Martin Zweig. He's a famous investor and really from our time frame. And he created a buy signal. It's called the Zweig breadth thrust indicator. And what it does is it looks at these very strong downward movements followed by a very strong upward movement within a 10-day period. And I'm simplifying that dramatically. It's actually fairly complex. Uh, that has only flashed a positive signal 18 times since 1945. So it's not very common, but it's sort of famous because of those 18 times, 100% of the time, the market was up a year later. And the average rate of return a year later was 23% up.
That's a pretty massive return.
It is. I mean, the market average is 11, right? It's a double.
Yeah.
And even the shorter term returns after the signal are pretty good. 8% return after a quarter, 3 months, and 15% average return, for the market after those 18 things for the 6 month. And so, the market is doing well. And again, of course, here's what we're looking for today. We want, and I'm a big believer in the close. We're above it right now.
Yep.
The close is not here yet. This is a live show. It's not recorded. We're not editing it. We make mistakes. It's kind of interesting to watch, but I'd like to see this market close today above 4,400. Not the end of the world if it doesn't, but it's reacting very, very well, and kind of everything we started talking about back in June. Hey, the market is stretched out too far. And it kept going for a while, but we were talking about a consolidation phase. We have that. Now we've seemed to have bottomed out that consolidation phase, and we're starting to hit check marks to get past that consolidation phase and continue up with this primary uptrend. And the next leg of this uptrend historically would be the strongest leg. And so, we'll see if that is true or not as far as that goes. We do have some, clouds on the horizon with the fact that the Federal Reserve has raised rates so much. And the impact to those rate increases are lagged pretty dramatically. So you've got this situation where you raise rates today, you might not see it for 3 to 18 months, and so they raised rates from 0 to 5.25 to 5.5, right? I mean, in that they have a range that they use for where they're targeting, and that's a big jump, right? It's a lot. It's not a big number. 5.25, 5.5 is really a nothing. If you look historically at where the Fed funds rate has been. I'm not worried at all about that level. I mean, it was at 19% in the late 70s, early 80s to try to break that inflationary spike. So that's a lot more than where we're at now, obviously. But again, the best 5 years in the history of the stock market was 95 to 2000, and the Fed funds rate was right around where it is now. So it's not enough to really slow things down. It's just sort of a shock to the system, and there's an adjustment that happens, and we go from easy money to tighter money, and the things that require easy money are going out of business.
Yeah.
Right? They are. And these kind of zombie companies and what have you, as they need to refinance that debt to stay alive, which they've been doing because money was easy, and now they can't get it because money's tighter. Commercial real estate could suffer from some of those things, all of these things that are out there. However, this is all being offset at the moment by the consumer. Maybe the consumer backs off at some point in time, but you lock up the consumer for a few years, they get out and they want to go do things.
Yeah. People are spending at such a high rate right now.
Yeah, and we're seeing it in high credit card debt, right? We're seeing kind of record credit card debt, which isn't a good thing, but is still a part of the story for what's happening here. And the reason, and this is the biggest thing to me, the number one reason that everybody got this wrong, okay? We were supposed to have this big recession this year. I mean, if you look at the second half of last year, I'd say over 90% of the articles I read, they were making a prediction about recession, where it was going to happen in the first or second quarter of this year. That's not been true. Matter of fact, we just had a gross domestic product report for the last quarter was 4.9%. I mean, it couldn't have been more wrong. Mm-hmm. And what they're missing is that historically, when you raise rates from 0 to 5.25, 5.5, you get a recession. I have no problem with that. I would have been all over that, because that is too much of an adjustment, too many things, something ends up breaking, all that stuff. But when you have this during a pandemic recovery, that's the difference.
Yeah, you get all the extra money you get to burn through.
Yeah, and there was extra money put out, right? Probably a lot of that's been used. Although I have seen some stats just recently, there's still a tremendous amount of money sitting in the banking system, in different types of savings instruments, that can come in. There's a tremendous amount of money that's not in the markets from the professional investors. Last show, 2 weeks ago, we showed that Bank of America bulls bear sentiment, which was ridiculous. So the fear was off the charts,
Yeah.
right? Which is exactly what you want to see, because once that happens, the market takes off. Look what happened. I mean, that was 2 weeks ago. We talked about that. The last 2 weeks, I think the market's up at least 8 out of those 10 days,
Yeah.
and up pretty substantially. This is a good environment. It's a good time to be an investor. It's a good time to kind of pay attention to what's happening. There's a lot to be learned. Now, I will say we're also at a fairly critical juncture here. We really don't want to break down all of those check marks that we just accomplished, getting to that new high, breaking up out of that support zone, and setting up above 4,400. We don't want to uncheck all of those here, because then we're not out of the woods. So what's going to happen here in the next week or two is really going to probably set up the rest of this run one way or another. Are we continuing down and developing this kind of, next leg to the downside, which again, there's a lot of people out there that think that might be what's happening, or are we breaking that little downtrend that we just had since the end of July and steadying up? This is the couple weeks here, in my opinion, that we really want to watch. The pattern's right now. I'd say the only thing that bothers me is look at how straight up that is.
Yeah, it's a really fast
Yeah,
ascent.
there's some others, right? Back there in 2002, right? There's a couple, but they all ended up failing pretty badly in the end too. So, when you get these big moves like this, we're bound to have some kind of, a pullback here. And yesterday was one part of that, in my opinion. But it doesn't have to happen, because there is a lot of on the sidelines. But it does make me concerned when markets move too far in one direction quickly. So we'll see how that plays out. But it's an exciting time to be watching this. This is historic. The pandemic, the recovery from the pandemic. My theme has been for years here that we're just unwinding the pandemic. You look at where we're at right now, where, if we take a linear regression line going back to the bottom of the 2008 downturn, we're kind of right where we should be. You look at the bond market, a huge bubble up all the way back down. We're right at where we were in the bond market, at least using the Vanguard Total Bond Market Index as a proxy, where we were in 15, 16, 17. We spent years there. So, good, bad, or indifferent for any results that we've had, in the last few years. We're kind of where we should be. Market is setting itself up to kind of continue moving forward to the way that it normally does. But, we'll see if that happens. But anyway, that's what happened this week. An exciting week last week, actually, too. So it's fun to talk about. But look forward to being able to talk about it again next week. Hope you can join us.